Hello, everyone. On behalf of the Montreal Exchange and all of our colleagues at TMX, it is my great pleasure to welcome you to the first installment of the new CDOR Transition Webcast Series, a collaboration between TMX and the Canadian Alternative Reference Rate Working Group, also known as CARR. MX is proud to play a key role, working as always in close partnership with our market participants in the adoption of a risk-free rate in Canada. For more than 3 years, we've been engaged with CARR and our stakeholders across the industry in the design and rollout of the benchmark 3-month CORRA futures contract, and on January 23rd, we launched the term CORRA 1-month contract in support of the transition. MX is committed to seeking out new innovative ways to address ever-evolving needs of Canada's capital markets for our participants, and to make markets better, more efficient, more responsible, and more globally competitive. In keeping with our client-centric approach, we partnered with a number of Canada's major banks on this initiative to ensure that we arrived at a workable solution that would meet the needs of participants on both the buy side and the sell side. As the momentum for this initiative builds and we move closer to key milestone dates in the timeline, we are working to ensure a seamless transition from CDOR over to CORRA for all stakeholders. This series of webcasts is designed to help this process move along. Produced in collaboration with CARR, the goal of the series is to provide important details and a full scope of the context around the transition to risk-free rates and the critical role they stand to play in Canada's markets. It is my great pleasure to introduce you to Toni Gravelle, Deputy Governor of the Bank of Canada. He is one of the 2 deputy governors responsible for overseeing the bank's financial system activities, and he is also responsible for Financial Markets Department. As a key member of the bank's governing council, he shares the responsibility for decisions with respect to monetary policy and financial system stability, as well as for setting strategic direction at the bank. Over to you, Toni.
Hello, and thank you for inviting me to say a few words as part of this CDOR Transition Webcast Series. I'd like to thank TMX for hosting these virtual discussions on the Canadian benchmark reform efforts. This series is designed to help market participants stay abreast of key issues and upcoming changes. TMX has been an important partner in these efforts. As we all know, robust and sustainable benchmarks are a key foundational component for financial instruments here at home and around the world. Private and public sector entities in many jurisdictions have collaborated for years to ensure a more robust and resilient architecture that will better support financial markets. This is why CARR, which is the Canadian Alternative Reference Rate Working Group, was formed in 2018. The Bank of Canada is a key player in this group, reflecting our mandate to foster a stable and efficient financial system. As part of this mandate, and as a public good, in 2020, the bank took over the administration and publication of Canada's risk-free rate benchmark known as CORRA, or the Canadian Overnight Repo Rate Average. While CARR's initial focus was on CORRA, it also took on the task of reviewing the other Canadian interest rate benchmark known as CDOR, the Canadian dollar offered rate, to ensure that Canada's benchmark regime would remain robust and resilient in the future. This analysis was carried out in the context of the new, higher standards expected of critical interest rate benchmarks. CARR concluded that review and published its assessment of CDOR's long-term robustness as a financial benchmark in a December 2021 white paper. In that paper, CARR recommended that RBSL, or Refinitiv Benchmark Services Limited, CDOR's regulated administrator, cease publication of the benchmark after June 2024. This recommendation was unanimously supported by all members of both CARR and the Canadian Fixed Income Forum. RBSL consulted on that recommendation and announced last May that it would cease publication of CDOR after June 28, 2024. The Canadian financial system has less than 18 months to transition from using CDOR to CORRA. Make no mistake, this is a large and complex task involving more than $20 trillion of CDOR exposure. Thankfully, all of this exposure is in the wholesale markets, which means it does not affect retail clients. The good news is that the global transition away from LIBOR has already happened for 4 currencies. And all remaining US dollar products will have transitioned by June of this year. As a result, many market participants already know what needs to be done to transition away from a benchmark like CDOR, and they have the processes and transition teams in place. We also have some lessons learned and best practices to draw upon from the LIBOR transition. CARR has been tasked with providing and executing a plan to ensure we have a smooth transition away from CDOR. CARR has developed a two-stage transition plan, reinforced by supervisory expectations that the Office of the Superintendent of Financial Institutions has laid out. To ensure success, these transition efforts will require extensive collaboration and coordination across all stakeholders. The first stage will require derivatives and cash securities to transition to CORRA benchmark by this coming June. The transition efforts are already underway, with CMHC moving its Canadian Mortgage Bond Program floating rate issuance from CDOR to CORRA last May. And the first of the interdealer initiatives to transition their derivatives activity to those based on CORRA was launched January 9th. And as you likely know, CARR announced in early January that there will be a 1 and 3 month term CORRA benchmark to help the loan market transition from CDOR. This rate will be administered by CanDeal Innovations, with TMX Data Link providing the licensing and distribution capabilities. However, we expect that term CORRA's use will be very limited. The vast majority of current CDOR exposure will transition to referencing overnight CORRA, ensuring a more robust financial system. This aligns with recommendations of the Financial Stability Board. It also mirrors what is happening in some other major jurisdictions where the use of the term risk-free rate is mostly limited to the loan market. But please note that any users of term CORRA are expected to have robust fallbacks in place should the rate cease to be published at any point in the future. Market participants also need to be aware that when publication of CDOR stops in June 2024, it is likely that the Bankers Acceptance Lending Model will also disappear. That means BAs will no longer be issued after that point. CFIF recently published a white paper on this, specifically looking at various investment alternatives to BAs that market participants could use. CFIF has also formed a working group to monitor these changes. Let me be clear on my bottom line message today. Market participants with exposure to CDOR through financial instruments or other types of contracts need to start working on their transition strategies now if they have not already done so. To help, extensive supporting material is published on the bank's CORRA and CARR websites. You can also view the CDOR Transition Webcast through the CARR and TMX websites. Thank you again for your time and interest in these important efforts, and please stay tuned for further installments in this information series.
Good afternoon, and welcome to the CDOR Transition Webcast Series. My name is Harri Vikstedt. I am a Senior Policy Director at the Bank of Canada and a co-chair of the Canadian Alternative Reference Rate Working Group, known as CARR. Today, Karl Wildi and I will provide you with an overview of the Canadian benchmark transition from CDOR to CORRA. Karl is Vice Chair of CIBC Global Markets and the other co-chair of CARR. This webcast is the first of many covering the CDOR transition. This one will provide you with an overview of the overall CDOR transition path. The webcasts that follow will target specific key areas of interest to market participants. For example, how derivatives are expected to transition. But before I begin, I would like to note that the opinions expressed in this webcast by Karl and I do not necessarily represent those of the Bank of Canada or CIBC. As Toni Gravelle noted in his opening remarks, benchmark transition is a large and complex task, but thankfully, we have the experience from other jurisdictions to guide us. So before we go into more detail on the Canadian transition, I wanted to provide some global context. This once-in-a-lifetime transformation to new interest rate benchmarks is taking place globally. It has been reinforced by the cessation in the publication of the London Interbank Offered Rate, or LIBOR as it is commonly known. We are moving globally from using forward-looking bank credit-sensitive rates to ones based on overnight risk-free rates. This is a foundational change to the global interest rate benchmark regime. 4 out of the 5 LIBOR currency benchmarks stopped being published at the end of 2021, with the remaining key US dollar LIBOR ceasing after June of this year. As a result, hundreds of trillions of dollars worth of existing and new exposure is being or has been transitioned to risk-free rates. It's not an easy or a simple task. To do this, systems and processes had to be changed or updated. New products had to be created, existing contracts had to be repapered, and new legal documents have to be drafted, etc. We are literally tooling or rebuilding the plumbing or architecture of the global financial system. This is an enormous task requiring extensive coordination and collaboration across jurisdictions, as well as between the public and private sectors, or within the institutions themselves. This is especially true for banks, where these rates are core to their operations and internal plumbing. This move away from credit-sensitive rates has been supported globally by central banks and regulators to ensure a more robust and stable financial system. So why is this happening? These reform efforts started after the global financial crisis. Confidence and reliability of these types of rates was undermined by attempted manipulation and false reporting, at least in some of them. But this was not the only reason. There was also a substantial drop in the liquidity after the GFC in the underlying interbank market from which they are derived from. In response, the Group of 20 asked the Financial Stability Board in 2013 to review the most widely used benchmarks, especially LIBOR, Euribor, and TIBOR. To do this, the FSB formed the Official Sector Steering Group, which was comprised of central banks and regulatory agencies. I am currently the Canadian representative on this group. To support the work, OSSG formed the Market Participants Group. This was composed of approximately 40 large global market participants across the various types of stakeholders. This included banks, dealers, asset managers, pension funds, and large global corporates. These firms provided the subject matter expertise to the OSSG. Also in 2013, the International Organization of Securities Commissions, known as IOSCO, published its principles for financial benchmarks. These principles form the basis for determining what is deemed a robust benchmark. They are also the core principles found in any benchmark regulation, including the one introduced in Canada in 2021. Global benchmark reform efforts gained speed in 2017 after the UK's Financial Conduct Authority set a potential end date for LIBOR. The FCA is the regulator of LIBOR and LIBOR's administrator, IBA. And in March of 2021, IBA announced the LIBOR end dates that I mentioned earlier. Hopefully, this has provided you the international context for the efforts that are taking place in Canada, which Karl will cover next.
Thank you, Harri. CARR was born out of CFIF, the Canadian Fixed Income Forum, and it is a Bank of Canada sponsored committee set up to ensure our Canadian interest rate benchmarks meet the new global standards expected of them. It's been quite a journey since we began our work in 2018, culminating in the CDOR transition we're here to talk about today. The CARR committee members represent many of the largest players in the Canadian financial markets, 22 of them, with half representing the sell side or lender community and half representing the issuer, investor, or corporate sectors. But the work of CARR has involved many more firms and a huge workforce of over 200 subject matter experts, particularly through the planning of our transition. CARR also collaborated with trade groups representing investors, corporate treasurers, banks, as well as derivative policy. Outside of Canada, we spoke to other working groups who were reforming their own benchmarks, so we could have consistency with global peers, but that also adapted to the unique aspects of the Canadian market. The efforts of all this work ensure our benchmarks will be robust and reliable for the generations to come. Now a little background on CDOR. CDOR is different from LIBOR in that it isn't a borrowing rate, it's actually the rate at which banks on the CDOR panel offer out their balance sheet to corporate borrowers. What's also unique is that since the 1960s, Canada's banks have lent to certain clients via what we call a BA loan facility. And once a corporate draws down on that loan, the lending bank issues a BA, a banker's acceptance, to fund the loan. There are currently approximately 160 billion of loans that are borrowed in this way. And like LIBOR, the derivative market used this lending rate as their primary reference rate. And today, there are approximately $20 trillion worth of contracts using CDOR, dwarfing the size of the loan market, and that's a problem we'll discuss in a few minutes. CDOR's benchmark administrator is Refinitiv, and there are 6 banks on what we call the CDOR panel, the group that submits lending rates from which CDOR is calculated. Today, there are 3 tenors published, 1, 2, and 3 months. And because of the importance of CDOR, it was identified as a critical benchmark under new regulations governing benchmarks. The OSC and the AMF are the regulators tasked by the CSA to oversee this regulatory regime. CORRA, Canada's risk-free benchmark, is notably different from CDOR. Instead of being a bank lending rate, it is the rate where market participants borrow or lend Government of Canada bonds or bills overnight in the repo market. CORRA is similar in construction to SOFR, the US market's risk-free rate. The beauty of CORRA is that the market for overnight repos on GOCs is very large and deep, and that's why we say CORRA is a robust rate. Another attribute of CORRA is that the Bank of Canada administers and publishes CORRA free of charge, as well as indices based on CORRA. This is a side-by-side comparison of CDOR and CORRA. I've spoken of some of their characteristics, but I will touch on a couple of other important differences between the two. Because CDOR is a bank lending rate, it therefore incorporates a bank credit spread, which is why we say it is credit sensitive. Another key characteristic is that it comes in 3 tenors, as I said, 1, 2, and 3 months. And it is therefore called a forward-looking rate, as it reflects a 1, 2, or 3-month rate today. So CDOR is a forward-looking credit-sensitive rate. CORRA, on the other hand, reflects Government of Canada credit, which is risk-free in Canadian dollars, and it is an overnight rate, not a term rate. Another key difference is that CDOR is based on a survey of CDOR submitters at the 6 panel banks, and they use expert judgment in setting their CDOR submission. CORRA is based on a calculation from billions of dollars of transactions. So CORRA is much more robust and transparent as a result. As CDOR is a forward-looking rate, borrowers and lenders know their payments in advance. Whereas with CORRA, as an overnight rate, borrowers and lenders would need to calculate a rate applicable over a particular term at the end of that term by compounding each overnight rate. While this adds some calculation complexity and operational considerations at the end of the term, it is the standard practice globally when using overnight RFRs. And while you may not know the exact payment amount at the start of the period, the market will tell you the amount it expects it to be. This is the rate of a 1-month or 3-month OIS or overnight index swap. As you progress through the period, you get more overnight CORRA data points you can forecast with increasing accuracy the end of period payment. And there are many system providers who sell software that can help manage this whole process. And for those borrowers who have difficulty using overnight CORRA, they can use term CORRA. More on that in a few minutes. Because CORRA is a risk-free rate, not surprisingly, its rate for a specific term is lower than CDOR for the same term. On average, over the past 10 years, 1 month CDOR has been 30 basis points over 1 month CORRA, or the 1 month OIS. This means that if you're used to borrowing money at CDOR plus 60, and the current CDOR CORRA or CDOR OIS basis is 25 basis points, then you can expect your new credit spread to be approximately 85 basis points. I've mentioned that there are about $20 trillion worth of financial products that use CDOR as a reference rate. The vast majority, 97% of that, is related to derivatives. And by derivatives, I mean swaps that clear through central clearing houses, over-the-counter or bilateral swaps between two counterparties, and listed derivatives like interest rate futures. The other products, while smaller, are still very important to our transition. They include loans, floating rate notes, and other bonds, securitized product like mortgage-backed securities, and bank deposits. CARR has done a lot of background work in each product area to ensure there is a logical and well thought out plan for each of these as they transition off CDOR. Now Harri is going to explain why CARR recommended that CDOR's role as a benchmark should end.
Thank you, Karl. When CARR was initiated in 2018, the focus was on CORRA, the risk-free rate. But in 2020, CARR was asked by CFIF to also review CDOR. CDOR had already been reviewed in the past, but those reviews had focused on CDOR's submission processes. There had been no fulsome review of the efficacy of CDOR as a benchmark. This was especially important given what had happened globally to other credit-sensitive benchmarks. They had either been reformed to be very prescriptive submission waterfalls or to become fully transaction-based. The review was also necessary in light of the regulatory banking reforms that had taken place since the GFC, especially as it relates to Basel III. These changes have had a major impact on the way that banks fund, which has materially impacted the structure of the short-term bank funding market. Therefore, we wanted to better understand the impact from all of these changes on the efficacy of CDOR. This was very much a forward-looking review of CDOR. We wanted to ensure that the Canadian benchmark regime remained robust into the future. While CDOR has served the Canadian market well for many years, the analysis pointed to 4 aspects of CDOR's architecture that could pose potential risks to its future robustness. First, there's the lack of transparency to CDOR. It is based on expert judgment, as Karl noted, and cannot be directly tied to transactions in public markets. This is due to CDOR's definition and its role in the BA lending process. Secondly, the BA lending model is no longer efficient and sustainable due to changes in regulation and funding models. The use of BAs as a source of bank funding has decreased as banks have taken on more sophisticated approaches to liquidity management. Basel III regulations introduced after GFC have also reduced the attractiveness of short-term funding, as I mentioned. Thirdly, the 20 trillion exposure to CDOR is not commensurate with the 90 billion volume of underlying BA transactions that indirectly support the benchmark. In addition, 90% of the exposure to CDOR is for the 3-month term, while 90% of the BAs issued are in the 1-month term. These are known as proportionality or inverted pyramid issues, and they are very relevant also to the other global credit-based benchmarks. Fourthly, as Karl mentioned, there are currently only 6 banks on the CDOR survey panel, down from 9 a decade ago. If 1 or 2 banks wanted to leave the panel, others would potentially follow, leading to a sudden cessation of the benchmark. The designation of CDOR in September of 2021 as a critical benchmark under Canadian benchmark regulation increased the risk of this happening. Given these fragilities, CARR investigated the potential for reforming or enhancing CDOR. CARR had already enhanced the methodology for CORRA, and as I mentioned before, other key global benchmarks had also been reformed. However, given CDOR's definition and design, it was agreed that it would not be possible to reform or enhance it. As Karl mentioned earlier, CDOR is a lending rate, not a borrowing rate that could be tied to specific market-based transactions. Even if CDOR could be directly tied to transacted BA yields in the market, the large spread between CDOR and the BA yields would mean that there would be clear winners and losers from an economic perspective from any change in the methodology or definition. So in reality, any rate based on BA transactions would need to be deemed a new rate. Since CDOR was clearly not sustainable over the long term and we could not reform or enhance it, CARR deemed that a carefully managed transition from CDOR was the only prudent option. CARR therefore recommended that RBSL should cease CDOR's publication after June of 2024. This recommendation, which was unanimously approved and supported by all CARR and CFIF members, is clearly laid out in the white paper that was published by CARR in December of 2021. In response to CARR's white paper, Refinitiv launched a public consultation on the potential cessation of CDOR. On May 16, they announced their decision to cease the publication of CDOR after June 28, 2024. This decision was authorized by the two provincial securities regulators that are responsible for benchmark regulation in Canada. Importantly, ISDA also stated that Refinitiv's announcement constituted an index cessation event under its updated benchmark fallback documentation, which included CDOR. This means that all cleared and bilateral derivative transactions subject to ISDA's revised fallbacks will revert from CDOR to overnight CORRA plus a spread adjustment. This takes place after CDOR's end date. The applicable spread adjustment was also published by Bloomberg that day. This means that most Canadian OTC derivative exposure is already covered by ISDA's robust fallbacks to CORRA. This is very important. The other key announcement that day was OSFI's publication of its supervisory expectations for the CDOR transition for federally regulated financial institutions. This, of course, includes all major Canadian banks. These expectations fully align with the two-stage transition path outlined by CARR in its white paper. I will quickly review the two-stage transition plan that we outlined. The first stage ends in June of 2023, or in just over 5 months. By this date, market participants are expected to transition all new derivative and securities contracts and transactions from CDOR to overnight CORRA calculated in arrears, although there are some limited exceptions for derivatives relating to risk-reducing trades or transactions that hedge loans. The second stage ends with the cessation of CDOR after June of 2024. This second stage provides loans an additional year to transition. New CDOR loans can be booked during this second stage, but they need to include robust fallbacks. Market participants can also continue to hedge CDOR-based loans with CDOR-based derivatives during this period. Part of the reason for the longer-term transition timeline for loans was the anticipated need to create a term rate, which would obviously take time and Karl will explain more on term CORRA in a few slides. Any remaining CDOR exposure after CDOR's end date will need to revert to the agreed fallbacks. So just to be clear, no CDOR rates will be published after June 28, 2024. Given the unanimous support by CARR and CFIF members for the recommendations to cease the publication of CDOR, we decided to revise the structure of CARR after the publication of the white paper. This was done to ensure that CARR was ready to begin the transition from CDOR to CORRA if and or when Refinitiv decided to cease the publication of the rate. This structural change included broadening CARR's membership to include a wider set of stakeholders. CARR also established 7 subgroups to carry out the work necessary to facilitate a smooth transition should one be needed. As Karl mentioned, we have had over 200 people working on various aspects of the transition from close to 50 institutions. Karl will now walk us through CARR's transition plan in more detail. Over to you, Karl.
Harri's provided the high-level elements of CARR's 2-stage transition. Here we've put together a Gantt chart with the key milestones and timeframes relevant for stakeholders who currently use CDOR as they transition to CORRA. The first 2 products, derivatives and securities, are prioritized as they must transition to using CORRA by June 30th. I will be going into each of these line items in the following slides, but I'll say that this is your best 1-page cheat sheet for the overall transition. The transition for derivatives really kicked off on Jan 9th with the first CORRA first date. This means that swap dealers started to quote linear or vanilla swaps using CORRA rather than CDOR to each other through the interdealer broker market. This approach was used in the LIBOR transition to great effect, so we have adopted the same strategy here. So far, it has been a success and brought attention and increased liquidity to the CORRA swap market. The second CORRA first date is on March 27th, when the interdealer market will be quoting cross-currency swaps and nonlinear or swaptions using CORRA. These 2 milestones will jumpstart the liquidity in the OIS or CORRA swap market. And at the same time, we expect liquidity in CORRA futures to build. Currently, the MX has a strip of 3-month IMM CORRA futures already trading, and they just launched new 1-month serial CORRA futures at the end of January. So all the building blocks for an active and liquid CORRA derivatives market are in place. CARR expects that clients will start moving their activity in earnest away from CDOR and over to CORRA around the end of this quarter. And we will be providing statistics on CARR's website so market participants can track the progress on a weekly basis. Like derivatives, cash securities must fully transition any new issuance to a CORRA benchmark after June 30th. CARR has already created and published recommended conventions for securities using a CORRA benchmark, as well as a recommended fallback language for CDOR and CORRA securities. That being said, the move to CORRA in the securities market really started last year. A number of banks issued using CORRA at the beginning of 2022, and then the biggest FRN issuer in the market, CHT, moved to CORRA issuance starting with their FRN in May of last year. CDOR has also been used in bail-in and NVCC bonds, but now CORRA has become the primary floating rate reference rate in these securities as well. The other piece of work for the cash securities subgroup has been the subject of legacy securities. Legacy securities are those that mature after June 28, 2024, the cessation date of CDOR. Most legacy securities have good fallback language and are easy to transition, but some have weak or no fallback provisions and have documentation that is difficult to modify. These we call tough legacy. A number of these tough legacy securities are callable by the issuer, so there is a remedy upon the cessation of CDOR. Only a very small number of securities, 3 in fact, about $1 billion in notional, will prove most challenging to remediate. These we call toughest legacy. CARR will recommend an approach to these toughest legacy securities, but we expect industry to work together to find a mutually agreeable resolution. Lastly, I will note that securities will only be able to use overnight CORRA, compounded in arrears, and not term CORRA. While the overwhelming majority of financial instruments that use CORRA will be using overnight CORRA, CARR was aware that there were pockets of the market that might need a forward-looking term CORRA. We saw this in the US when they adopted a use case for term SOFR. So the first thing we did on this file was consult on the need for a term CORRA rate. The feedback was consistent and persuasive. The loan market wanted and needed a forward-looking term rate, as did the trade finance business. So CARR set about to build one. We created a term CORRA methodology built on futures transactions. We developed a use case for those that wish to license it, and we selected an administrator. The use of term CORRA will be limited to loans, derivatives associated with loans, as well as trade finance. Term CORRA will be administered by CanDeal Innovations, and they will work in partnership with the TMX in producing and managing it. We expect that term CORRA will begin to be published officially at the end of Q3 of this year, though it may be available in beta form before then. The last but important thing I will say about term CORRA is that while CARR has developed it to be a robust and regulated benchmark, the long-term viability of it will depend on ongoing and consistent liquidity in the 1-month and 3-month CORRA futures. Because there is some level of uncertainty, we expect institutions that use term CORRA to have robust fallbacks to overnight CORRA and the operational capacity to adopt it. While loans represent less than 1% of the overall exposure to CDOR, they are almost certainly going to be the most labor-intensive to transition. The BA loan facility has been a core piece of the lending infrastructure for the past 50 years, so changing it was always going to be a challenge. That being said, with the advent of a forward-looking term CORRA benchmark, the transition will be much more straightforward. CARR has provided industry with a recommended convention for loans using overnight CORRA, and we will also be doing that for term CORRA, likely by March of this year. And previously, CARR published recommended hardwired fallback language for CDOR-based loans. And while we expect the majority of borrowers to prefer using term CORRA, CARR is encouraging those institutions that can use overnight CORRA to do so, particularly those that are active in the derivative market. Lastly, CARR expects to publish a white paper explaining the considerations and implications of using a risk-free rate as a benchmark rather than a credit-sensitive one like CDOR. As you can tell, there is a lot going on with CARR's transition, and staying up to date with our progress will help you with your own transitions. Now I'm going to turn it back over to Harri.
Thank you, Karl, for walking us through the key points that market participants should be aware for the CDOR transition. One of the key roles that CARR plays in this process is to promote market awareness and preparedness for the CDOR transition. This includes these webcasts, which in the future will bring subject matter experts to speak on specific issues relating to the transition. Most of the product-specific slides that Karl covered will also be covered in more depth, so please make sure you are registered to receive notices for the upcoming sessions. We will continue to update the transition roadmap and milestones document that Karl spoke about as the work progresses. So also please keep an eye on the CARR webpage that can be found on the Bank of Canada's website. We are working closely with each bank's IBOR transition team through the CARR Communication and Outreach subgroup to facilitate effective and uniform communication with each bank's client. Market participants who have questions or concerns about their CDOR exposure, or who want to better understand what is happening with the CDOR transition, should be talking to their banker or dealer, or to their accountants or external lawyers. CARR is also working with major system vendors to ensure system preparedness for the transition ahead of the key milestone dates. We will publish in the next few months an impact assessment checklist to help market participants. A key difference between the LIBOR and CDOR transitions is that our transition has major implications for the Canadian money market. With the cessation of CDOR, we expect that BAs will cease to be issued. This is because the BA-based lending model through which BAs are issued will also disappear. This is because it is intrinsically tied to CDOR. For more details on this, please see the CARR white paper. BAs are an important money market asset, accounting for approximately 20% of the total money market assets. They are an important investment product, especially in the 1-month sector. CARR identified this change to BAs in its recommendation to cease CDOR. And to look at this issue and discuss the potential replacement options to BAs, CFIF held a number of workshops last year with a wide range of BA-related market participants. The summary of these discussions was published earlier this month by CFIF. And I would highly recommend that any BA investors read this published summary paper, if they have already not done so. CFIF has also agreed to form a working group to monitor and help facilitate a smooth transition away from BAs. Karl and I would like to take this opportunity to thank you for watching this webcast. Transitioning the Canadian financial system from CDOR to CORRA is a monumental task that will require coordination and collaboration across all stakeholders. In order to ensure that you receive all the latest CARR announcements, please sign up for CARR's email notifications through the CARR website. For questions on any aspects of the transition, please email CARR at the email found on this slide, or talk to your banker or dealer or your legal or accounting representatives. We would also like to thank TMX for partnering with CARR on this CDOR Transition Webcast Series. The next webcasts will cover the key issues relating to the transitioning of derivatives and cash securities and are expected to be released in the next couple of weeks. This concludes today's webcast.